We're snorting cap rates and shooting up cash flow here at Deal Junkies.
Welcome back to Deal Junkies. It's Dane again, with Trevor Howard, Mike P. Nuss, and Jaryn Montgomery, back for his 6th episode on Deal Junkies. We're so happy to have you back. I'm going to be honest, though, today we're not... Well, Jaryn likes talking about this stuff, but we're going to talk a little bit about econ for Mike to ease his craving.
No, this is for
sharing.
the audience to get excited about life.
We're going to talk about econ for the audience.
We had more moments. There's times where you just need to talk about it.
Mike's about to tell us why the market is getting better, why our real estate is all about to increase in value.
Why rates are going down.
Why rates are going down. Why...
Down. That
actually wasn't even one of the buttons. Mike made that noise. Mike's gonna tell us all about it. Mike, what's the big news? What's the big news, big guy?
Okay, so the 4-year closed under 4%. The 10-year closed under 4% yesterday.
Whoa.
That's a big deal.
That's big news.
Oh, wow.
That is a big deal.
Trevor's.
I know. Trevor.
Oh, wow.
No, that is huge.
It is a big deal. So we've talked about it getting under 418, which it did.
The Lord of the Rings number.
Well, I'm wondering because we haven't locked all those rates on those loans we're doing right now.
Oh, does he actually care about this stuff?
I do right now.
We locked on a loan earlier this week.
Oh, we did?
Yeah.
So what'd we lock? Oh, no, that one. But no, these new acquisitions we're going to, I don't think we've locked yet.
Oh,
and it's based on the FHLB will track the 10-year, correct?
Yeah, correct. So essentially since about 10 days prior to the last Fed decision, which was like mid-September, so we've had over about a month now, the mortgage market has been very just blah, right? Not a lot of movement. It's just been blah because we've had the movement. Because we had the jobs rescission in August, rates went down, they trended down. We had the Fed cut, so then they bounced back a little bit. We had that initial bounce. And so from when the jobs revision came out to prior to the Fed cut, we broke below that 418 line. And we've talked about it. We don't need to get into it, but every time we got up close to it or 425, we'd bounce off it. We'd never get under there. But the great thing prior to the Fed cut is we got under the 418. We stayed under the 418. We hovered in the 4.03, 4.05 prior to the Fed cut. And then we knew that once the Fed cut, the bond market would overcorrect and then bounce off of that. So it's bounced off of the 4.03. We've had some reports that would suggest interest rates need to go higher. And so then the 10-year yield did go higher, but it never really went above 418. It closed around 4.2 once, but it's kind of effectively had a ceiling of 4.15. What's come out recently, what came out yesterday or this past week was Jerome Powell. Two things said. They talked about, one, they're now looking at no more tapering off the balance sheet. So we've talked about that. So the last time we had essentially two significant downward movements in yield last year was in June when they started tapering, lowering the amount of debt they're allowing to taper off their balance sheet, and then the jobs revision in August. And so this year it's been reversed. We had the jobs revision in August, which put downward pressure on interest rates. Then we had the Fed cut. And now as we're going into the next Fed cut, we're now talking about stopping the lowering of the balance sheet, so the tapering of the balance sheet. So those two things should be more downward pressure on interest rates, which is what we saw the past 2 days, which is they've closed under 4 and they have not gone back above 4. So it's very possible that we're now seeing a ceiling to the 10-year at 4%. So if we see a ceiling of the 10-year at 4% and then we get mortgage spreads down to 2, now we've got mortgage rates at 6%.
Where are they at? Like in the commercial world, we're at like 225 to 275 spread.
Yeah, rates got down to like 6.1 and then bounced back up to 6.3. And so now we're kind of back in the for like 30-year conventional mortgages.
It's like a 210 bip spread?
It's ish. Yeah, to the low twos. It's been up to like 2.7, approaching 3 when it's gotten bad. Historically, it's more like 1.7 or lower.
Oh, really? Okay.
Correct. So if we can get it down to 2 and keep it at 2, now we're in the environment where we have 6% mortgage rates. So instead of looking at, man, interest rates are 6.7 and we're trending towards 7 and we just need to get them to 6.5 or 6.4 to increase volume. Now we're in they're around 6%. They trend up to 6.15. So instead of getting down to 6.15 and activity taking off, that could be the next ceiling. And so now we're trending from really if we can get to 5.75. So we're on our way to seeing 5.75 to 6.15 interest rates.
Do you think cap rates will further compress from there? Or stay
Yeah, they kind of have to.
Range?
And that's what,
but then you have positive spread, and I feel like that's where the deals trade more so, because you think they'll drop, and because right now deals are trading 6.5 to 7 cap ish, or 6 to 7 depending on obviously a bunch of factors, but I feel like they would stay at.
You're getting positive return on leverage instead of a negative return on leverage, and that's why we've had really slow transaction volume, is because you have negative return on leverage. Mm-hmm. But we're getting close to that equation being flipped.
Yeah.
Seller finance. So you want to talk deals? So I got FOMO right now because I'm letting Daniel have a 10 unit that we got. Seller finance deal, $1.8 million. They want 10% down, 5.5% interest. 100% occupancy, slightly below rents. They've renovated 7 of the 10 units. Really nice construction. Really,
what
it is
cap
stable.
rate are you buying it
at? Buying it just over a 7. It's an 11% cash on cash return.
Is it an IO?
It's an IO. So we structured it as an IO for 4 years, and so essentially $1,700 to $1,800 a month would go to principal reduction if it was amortized payment. Yeah. And so we went IO to create $1,800 a month of cash flow, which then creates a 11% cash on cash.
Then you
return.
go to a 30-year AM at year 5?
Correct.
How long is the total note for?
20 years.
Why are you not buying this?
Because I need to focus on the 46 unit fundraise. And so I don't want to be going and trying to raise $200,000 of capital to go buy this 10 unit when I need to focus on raising another $800,000 on the 46 unit.
I would do that deal with you.
The 10 unit?
And raise all the capital.
I'll find the capital.
The 10 unit?
Yeah.
And then you get to do nothing. Do you still have control of this deal, or did you give it away already?
Shoot.
No, I've already promised it. And part of my mission is my staff owning real estate. So this is a big deal for me to see.
Does your staff
Part of my mission is my Jerry owning real estate.
Does your staff already have the money for it, or they need to go raise?
No, it's already done deal.
Oh, okay.
Yeah. So they've already had the capital. And the timing, timing works out. Whereas one of their private capital lenders, who they've been working with, they bought him and a partner bought a couple properties together. They're cashing out a CD.
Mm-hmm. Yeah,
so now they're going to train the CD for a note. And
when did you promise this to him?
A couple weeks ago.
Jaryn, if you would have just called Mike
this is
when
why
I
you
said,
gotta talk
dude.
to me, man. What about the 40? Let's just go buy the 46 unit. It's the same numbers.
Yeah.
Okay.
Dude, there you go. You wanted to do an apartment deal.
Let's do it.
What do you need on the 46 unit capital?
$2 million. So it's like a $2 to $2.1 million total.
How much can you raise, you think?
I don't know.
$1 million.
What's your guess? What would you target? Let's say you have this deal. You
How
like
long
the deal.
do I have?
3 months, probably, right?
No, we need to close in 2 months. So the syndication paperwork is essentially done. We're doing the reviews. Bank accounts are created. We're ready to actually advertise and take capital.
So 2 months. How much can you do?
I'm probably $400,000, $500,000, somewhere in there.
Would you let him join the deal if...
It's probably too little too late at this point, unfortunately.
Should have called Mike earlier again, dude.
But we can talk about doing other deals. Because
Let's
that's the
do
beauty
other
of it,
deals.
is there's other deals to do out there. Yeah.
So how's that deal going? What are you learning from it? What roadblocks are you facing?
Yeah, I should have gone down the loan process sooner. I was really focusing on the due diligence portion of it.
You think you'll still get the loan to close in time?
Yeah, and we've got a built-in extension.
Okay.
Yeah, so we can extend it to January. We can probably extend it again beyond that. I really didn't want my earnest money to go hard, but they also wouldn't agree to it.
I would let it go hard if it's a deal and you have time to finance it. Your biggest roadblock won't be closing necessarily, but it's finding the right lender for it and getting them to do it in a timely manner.
Yes.
Because all the they should be so quick right now, because they're not that busy.
slow.
They're not that busy, and they're taking so long.
The lender feedback is it's a really simple, it is a really simple deal. There's good debt coverage ratio. There's
Lenders
good
are
in-place
liars.
income. But I understand what they look at, and I agree with them from a looking at it standpoint. There's really strong in-place cash flow day one, and that's kind of the biggest factor, which I like for it.
Then have you started calling friends and family on this deal yet?
Yep.
How's that been going?
Or have you just been calling strangers?
I haven't actually called any family. I don't.
I use
really
that term.
Raised from family. I've just called a handful of people that I know, like, and trust right now. And so I've got 250 in soft and probably another 200 on top of that. And then as GPs, we're putting in 200 and then another 600 in LPs. So we've got like 1.2 to 1.3 of the 2 to
Oh, you're almost there. You're good.
that we need.
Easy.
Yeah. And so what I've been waiting for is the syndication paperwork to be done so we can finish a pitch deck so we can actually advertise it. So
have you made your pitch deck? You've drafted it up.
Yeah, exactly. So the goal is to use this syndication to actually create like $4 million of investment capital.
Yeah,
and
once
then
you
buy a
execute
deal
the
right
business
at the
plan.
same time. Yeah, because Q4 is a great time to buy deals. And
Wait, repeat that. I assumed you
So we
meant
need
like you
$2
do the
million.
business project and now you created equity that you roll to the next deal. But you're thinking,
No, just do multiple deals.
oh, because you're
Yeah,
talking
yeah.
to people now. They're not ready right now, but they're ready for the next
Correct,
one.
exactly.
Okay.
Yeah. So essentially get $4 million in investment capital, use $2 million of it on this project.
Yeah, gotcha.
And it's a 5-year hold, so we've modeled it as a 5-year sell. We could probably sell it in 3, which would really juice the returns.
Yep.
Because we have the exit as a 6 cap.
Do you not want to hold on to the deal at the end?
We could. I'm not modeling it that way. I think it's just easier. Like the questions that I get asked is, well, what are you doing? What's this? And it's just easier to have one clear, we're going to sell it at year 5. These are what your returns are like. That's what I found. I don't want to say, well, we can make this. We can. Once you say we could, or then you lose interest.
Yeah. Okay.
Then that.
I agree.
Yeah.
You lose interest, but it's not that you're losing interest because the deal isn't as good.
It's the investor.
because it gets more confusing.
Exactly.
And so it's like you don't want to hold the deal, and it's like, of course I want to hold the deal, but if I am gonna hold it longer than 5 years, then am I holding it for 7 or 10 or 15 or 20? And then what am I pitching them on? Right. Like if I don't have a pitch, how can I sell somebody on something where it's like, well, we might sell in 5 years, but if we hold it, then you're going to have made some amount of money, and then we might hold it for some amount longer,
Right.
and then you might get a pretty good return.
Right.
But it's like you don't have if you don't have concrete, like this is our game plan, then 5 years from now or 3 years from now, you can be like, hey, we could sell it or we could refinance and you could pull out this amount of money. But then you come to them with exact numbers at that time and you're saying we're refinancing year 3. We're going to get all of our initial capital out plus 20 grand or whatever, 20% more than our initial capital. And then we're going to hold the deal. Your return over the next 5 years will be 18%.
And the different types of deals dictate how you do that. So like on the 14 unit and the detox facility, it's completely different. It's value add. There's no income for the first 12 to 18 months.
Mm-hmm.
And so we're refinancing, we're getting all our capital back, and we're going to hold in perpetuity because we didn't get any income. That was the
I really like
strategy of
those
this.
deals where you get all your capital back and then hold in perpetuity, because then you build real wealth and then you can redo the deal. And
I prefer those deals, but that's harder capital to raise.
It
and
seems
it's a
like
lot
it should
more
be
work
easier.
to do.
Is that because they're not understanding, like as an investor?
It's riskier. It's just risk. It is more risk.
It seems like less though to me, because you recapitalize, you pull all your money out, you have no money in the deal at that point.
And true risk doesn't matter. It's perceived risk.
Yeah.
So to you perceive very little risk because you're very comfortable with it. People with capital that are not comfortable with it. And in the typical avatar you're talking to is they're making even less savvy decisions, which is, do I go in bonds? Do I go in stocks? Do I do an alternative real estate investment? And so now if you're like, well, you're not getting any income, you're taking it from a dividend producing whatever to now you're no income and you need so there's different.
But in the stock market, they have no income.
Well, unless they have a dividend stock or if they're blended
like
with bonds.
S&P,
And again, understand your avatar. So if you've got a young person that they don't want any income, they just want their stocks to grow in value and they want to create capital gains. Or are you talking to a more retired person who wants the income and they want the safety? And typically the avatar that works best for your deals are those people that want safety and want income because they have lower expectations for the returns. And so, but there's different types of projects to blend with different people. So if you look at my investors on the value add play, they're younger and they want the juice. They want the risk. They're all real estate professionals. They all value significantly from the bonus depreciation. They're in it for the upside of the risk. Whereas this is different. It provides income from day one. There's a very clear and easy pref. We think we can sell it in 3 years, but we're modeling it out to sell it in 5 years. If these metrics withstand, then we can easily refinance in 5 years, get all the capital back, plus a little bump, and then at that point we may hold it. But it's easier to show a package of you're going to make this amount of income for the next 3 to 5 years, and then you're going to get this equity multiple at the end.
Do you have the option to buy them out and you can hold it at the end?
I'm not structuring it that way because I don't want to complicate it.
Yeah.
So this is the first time for me to do this, and I just want the very
simple.
easy experience.
I like that. That's very wise.
Yeah, and so we did so Caleb and I are the partner, and we brought on a third GP just to make the banking side. He's more liquid. He's not as young. Like, it's funny. My real estate portfolio is worth significantly more than his.
But he has this specific asset class experience.
Well, I have a lot more debt. So he has less real estate, but more liquidity and more net worth. And so you kind of look like we look flip-flopped. We're inverse on the application, so that kind of helps that portion of it.
Yeah, I think part of the problem we run into is there's so many ways you can do these deals.
Yeah, and you don't want to make it
it needs to be as simple as possible for people to actually know, like, and trust the deal.
Yeah, and then part of this whole process is, okay, well, what type of softwares are you using? And so, okay, well, you got to look at a future path. So again, why I want to get on platforms and I want to advertise it so I can get a pool of a lot more investors. And so now you start pairing those right.
Do you think you're talking about investors that you don't yet know?
Correct.
Do you think you'll get traction from those people?
Yeah, so that's why we created a 506C, so we specifically can advertise it.
We do 506Cs, and then we don't bring anyone in really that we don't know. It's usually a referral from someone.
That's what I expect.
Because I think it will take so long to build that relationship with that person, you won't get that capital into this first deal.
But the reason you want to create the 506C is because you want to be able to advertise this deal so that guy sees that, and then they invest in the fourth deal.
Yeah.
And you do a 506C to get exposure and brand awareness, so you do 506Bs in the future.
Okay, cool.
True. And then you can bring on unaccredited investors.
Yeah, and even with the 506C, right? So all your accredited investors are going to come down this funnel, but non-accredited investors will still reach out to you, and it's like, well, you just go in this other funnel.
Yeah, explain the 506B.
506B just means that you can't advertise at all, so it has to be somebody who you have a prior withstanding substantiated relationship with, and those are still mostly accredited, but really they don't have to be, because you can have up to 35 unaccredited investors, but you have to have a substantial relationship with them already.
It's the other way around. It's the other way. 506B is for unaccredited investors. You can have up to 30 accredited investors. So in a 506C, you can advertise, but you can only have accredited investors. In a 506B, you cannot advertise. You can have non-accredited investors, and I think there's a cap of 30 accredited investors. Pretty damn sure I'm correct on that.
So if you're advertising, they have to be
accredited, right? So we're taking we're making the choice that we can only accept accredited investors in this 46 unit syndication because we went the 506C path. And the reason being is we're trying to build a magnet bigger than $2 million, so that way we have excess capital that can roll into other deals. And then those don't need to be marketed because we've already created the relationship. They're already in our software. And then we can start categorizing passive investors for what's their appetite, what are they trying to look for.
I like it.
So there's no cap on accredited in a 506B. You can only have 35 unaccredited investors.
Oh, is that okay? So I was looking at backwards. Okay, yeah. Dane was fucking right. So, but one of the sexiest
I gotta know my SEC regulations.
But going back into economics, so Caleb went to the Pacific Northwest Multifamily Conference yesterday in Seattle. Let me pull up some quotes.
We should be doing 506Bs, I feel like. No?
You love posting stuff on the internet too.
Oh. I don't post any of it, but I think we should think about that.
Point stands.
Okay, so
somebody posts stuff for
Clyde Holland of Holland Partners. He thinks the next 5 years.
Sorry. Start over, Mike. Sorry.
Clyde Holland of Holland Partners. So Holland Partners is a large apartment. They have multiple asset classes. They're institutional holders of real estate. Thinks the next 5 years will see the highest rent growth in his 40 years of investing.
I told you.
So this is a Pacific Northwest guy talking specifically about the Pacific Northwest.
Why does he think that?
And then he has slides that go into it's the construction pipeline, the cost to build, so it's a lack of supply. So it's a constricted supply versus demand will stay stable and grow. They did project the C class in Portland 4.5% rent increase for the next 2 years. So in the worst part of like the next 5 years is probably the next 2 years, and they're still projecting 4.5% rent increases. And so like when you look at our 46 unit, we would qualify in that asset class. We projected 3% rent increases, and even then just started at our current rents now, which I believe is below market, and then doing 3% rent increase bumps based off of that.
Where do you think rates will ever go back down into 3-4% range?
I do.
No, it's
You do?
I did. If you would ask me this a year ago, I would have said no, but I do right now.
Why?
I want to hear your thoughts, and then I'll explain mine.
if you think of it an aspect of how do you actually pay down debt, you need to get interest rates below inflation, or at least close enough to inflation that inflation's helping you pay it down. So in that aspect of the fact that we have so much debt, I can see a big pressure to get interest rates down.
From the like the U.S. standpoint.
Yeah, correct. Exactly right. So if we have inflation's at 3%, but we can get our borrowing costs down to 2%. Now every year,
leverage,
exactly, we're paying down our debt through inflation, and so there is a value to that. And so I understand the component of trying to make that happen.
And that's like our bond price versus
Correct. Yeah, exactly. So America's borrowing 2% because our 10-year yield is at 2%, right? So we're getting enough money on the money we're giving out that it gives them we pay 2% in interest rate costs.
Okay.
And then if inflation is higher than that, but it's less than 3%, so it's in check, it's okay for consumers can still be healthy at interest rates at that level, then you can have those interest rates down that low. The problem is our inventory, the way I see it, is we've done so hard to take $2.2 trillion off the Fed's balance sheet that we've gone through the deleveraging process. We've built up supply chains, like inventory levels, especially on the real estate side. The question is, do we have inventories built up enough, or do we have productivity at a high enough level that if we do put downward pressure on the interest rates, that we won't have the increase in inflation to offset that? And so you can go into the camp of, yes, we've got enough inventory right now. We can create enough productivity that we can lower interest rates, not increase inflation. Then that allows us to continue lower interest rates. Or you can look at it aspect of, we don't have those inventory channels, we don't have the supply chains, and if we lower interest rates, that's going to start putting up inflation, and now you just have this back and forth, and then interest rates probably go down a little bit, but they don't go down significantly. I'm more of that camp where I think we're going to slowly ratchet down, and we'll probably battle back and forth. I think, and the reason being is if you look at the long-term debt cycle, is essentially we had a debt reset in 2008, but we built our debt up too fast from 2008 to 2025 that we essentially just had a debt recycle with the Fed pulling $2 trillion off their balance sheet. So we can create more debt and we can have low interest rates, but they've only pulled off $2 trillion of their balance sheet. So there's a limit to what that can be. And so I don't think we're going to get interest rates down that low. I do think that we will see interest rates trend under 6, get down to 5.75, potentially less than that in the next 18 months. And then cap rates will compress because of that. And then because cap rates have compressed and because you have positive leverage on debt, transaction volume will increase. So the best thing is we're going to see a lot of price discovery. I just don't know that price discovery is going to be really good price discovery.
I agree with all of that in the next 5 years.
Yeah.
But if the question is, do I think ever they will go back down to 3%?
Yeah.
I said no, that should never happen again because that was a bad idea. But I think that historically, for whatever reason, we were okay with raising interest rates much higher than we did at this last reset. And this last reset was like the time when you would think you would do it, if you were ever going to do it, in my mind. And I just looking at all the other cycles, like this should have been a short-term debt cycle, but it kind of felt like a blend of the two, where it was like almost a long-term debt cycle, but not really. Like we didn't have the total all the way.
It's like a hyper debt cycle.
Yeah, it was weird.
Yeah.
And that's and so that
What are you talking about, like right now from 2020?
Like right now, yeah. So you would have thought when we peaked on our debt this time around, that it would have been higher, because the higher
interest rate?
Yeah. So the higher that interest rates go, where you can still have a productive economy, the better, right? So the really, like, the more expensive credit is with an economy that's still working, the better. The
better for who?
The better for everybody,
Okay.
right? Because then you have inflation under control, and you're not losing productivity. And so if the economy is still doing what it needs to do and functioning in a healthy manner when interest rates are high,
Meaning
then
GDP is increasing?
yeah, GDP is increasing. Your inflation is under control. Like, everybody's wages are growing relative to their cost of living, right? Like, that is a good thing. And historically, like, you kind of want that to sit at like 8 or 9% from everything that I've read.
Interest rate perspective?
Yeah. You want rates to be in like the 8 to 9% range, and we peaked at 6 for interest rate range, meaning like mortgage rates. We peaked at like 7. Some of them hit 8 on like jumbo loans, but that was like a week. It wasn't long at all, and then we just dipped back down really quick. It wasn't stable at that number because the economy slowed down so much when we got that high. And so the biggest reason that you want interest rates to be able to get that high, and for the economy to still be running well at that level, and productivity to be high, and jobs to be in a good spot, and the wages relative to cost of living to be good, which right now they're not, frankly, in some places more than others, like specifically hubs of where people are, Portland, San Francisco, LA, like those places, your cost of living has increased so much over the last 5 years, and wages have not kept up. I did read something that there was a couple markets that are big that it was still good. But anyways, moral of the story is, the reason you want that to be the case is because interest rates are one of your levers. And so if the market is really strong when interest rates are 9%,
you can adjust.
And
easily.
then, like, for whatever reason, something happens,
you can drop
and
them.
you need to drop them a little bit.
Easy.
Then you can drop them and not be at risk of hyperinflation, or just like a little bit more inflation
But if
than
it's
you want.
at 3,
But if you're already at 3, and then you're trying to like beat the floor of like, you can't go any lower.
And that's where the printing comes in.
And that's where the printing comes into play. But that's the idea of like, okay, do I think it's ever going to happen? Yeah. And the reason I do is because we're about to stabilize
think
at
of it,
like 6.
Think of it as a stepping stairs. Think of it as a staircase. So we're on the back up of the staircase. So if you go down a staircase and then you're on flat ground, and you go up the staircase. So going down the staircase, if you start at the 80s when we had the chaos of debt. So if you just look at the yield on the 10-year, we had the chaos of the 80s, but then we get these essentially tranches. So we talk about the channels that the 10-year trades in, and then that just stepped down decade by decade. So in the 90s, you had 7 to 8% interest rates. Or like in the late 80s, early 90s. And then in the late 90s, you got that down to 6 to 7%. And then in the early 20s, you got that down to the 4 to 5%. And then at that point, once you got past 2008, the only way to get it down below that, and so prior to 2008, we're in the 4 to 5% range. The only way to get down lower than that is you slam interest rates to 0 at the Fed level and then print more money. Mm-hmm. And so now you're devaluing your level. So then when we got
your currency, right?
Correct.
Yeah.
And so then the 10-year yield essentially hovered from 2008 to 2016 at around 1.5%.
Super low.
Super ridiculously low.
Yeah.
And so we started to taper off. And so we started to go back up until 2019. And then we had the actually inverted yield curve in late 2019. So prior to COVID, rates started to go back down to fix the inverted yield curve. So it was, we're going to be a backstop. We're going to buy as much debt as we need to buy in order to fix the markets. And then COVID happened. And then when COVID happened, we went down to this floor where the 10-year yield was 0.31%. And so now you're at the very bottom of the stairs. And then instead of stair stepping up and going from 0.5% to 1 and 1 to 1.5, we went from 0.5% to 5%. And so it was like an elevator. And then that created the stress on the market. Mm-hmm. And the problem is on the way down, at some point, your asset values get tied to those low ass interest rates. And so now that those asset values are tied to those low interest rates, your transaction volume stops once it gets above a certain rate. And so you have to bring it back down in order to create transaction volume. And so I do think that we'll get to a point down where we can create the transaction volume. The question is how far down below that lever do we get?
Mm-hmm.
Do you think the 10-year will ever go back up to like 10 plus?
No, I don't, because our market and this is where I started to disconnect myself from the All In podcast, was because Chamath was on there saying the 10-year can go to 8%, 10%. That would be absolutely devastating to our housing market. It would cause a global recession.
Yeah.
And so the Fed would never allow that to happen.
Never say never.
So, but I would say, like, we will get interest rates back down again. The question is, how old are we going to be when that happens?
Yeah. I think the cycles are shortening.
Yeah.
I mean,
Now,
we've talked about that.
If we were
I don't
able
know
to say they were able to pull $4 trillion off their balance sheet instead of $2 trillion, well, now we have a bigger runway where they can keep them lower for longer and put downward pressure. But we didn't. And so the reason our asset values are tied to interest rates is because the amount of money we have in the market, as much as it is the cost of money.
Yeah. No, I agree with all that. I think that it'll happen at some point in the next, not that long.
Yeah.
Like 10 or 15
Like,
years.
we're running out of time to negotiate really good deals. And I think that's what, like, Caleb was really excited about going to that because that's essentially, it's still a bad brand awareness standpoint, especially for Portland. So there still isn't a lot of capital there, but it's not going to be long. And bad, low brand awareness or brand value when money is on the sidelines is one thing, but when money gets released, that low brand value gets overlooked a lot faster. It's like if you have a house on a traffic street, when you've got a whole bunch of competition, the market's down, no one's going to buy the house on the traffic street. But when everyone's trying to find a fucking house, I don't care about traffic. That's not that noisy. We can close the door, close the windows, right? They make excuses. And so once capital gets released, these submarkets or these deals, like the coast, right? Like, you guys are ripping deals at the coast. Well, it's this and it's that. It's got these warts on it. Those warts go away when everything starts looking rosy.
Jaryn, any input on interest rates?
Nope.
He was
Be cool if they went down a
He's
little bit.
tentatively looking.
He's a good listener.
But so that's why you try and build these pipelines, right? So you have now the ability to refinance and create value just by manipulating.
Oh, I think the next 5 years are going to be awesome. Yeah. No, I mean, we've had a not so fun 3 years, and I think we're just coming right back.
I've had a lot of fun these past 3 years.
They're going to have even more.
Yeah.
Asset accumulation mode is really, really fun, but asset
Refinance mode.
consumption. Yeah.
All right.
Yeah, we
Well-
closed a refi today, right?
Congrats.
Yeah, we did.
Which one did you refi?
Our 42 unit we pulled.
Yeah,
What did
that
we pull
story.
out of it?
Our 40 unit in Astoria.
Oh, 40 unit. What did we pull out of it?
We pulled out.
$2 million.
Yeah.
That's cool.
Did
Go
you
to
get
dinner.
your?
Let's go celebrate.
It's a good day.
You guys want to buy a 46 unit with me?
I know a guy that might. All right. Well, thanks for sharing all the numbers. Both Mike and Trevor. We appreciate you guys listening. If you enjoy our podcast, please share it with one person. That's all I'm going to ask every time Gabe asks you to share and like and subscribe and all that stuff. Just do one thing. Just share it with somebody who you think would enjoy listening to it.
And if you DM us that you did, I'll give you Dane's personal phone number so you can become friends with him.
That
doesn't
thing's
text
already
back.
everywhere. Yeah. I text some people back. Anyways,
You're calling
thanks for
yourself
listening, guys.
low-hanging fruit? Low-hanging fruit.
I guess so. Trevor doesn't ever text back either, but nobody has his phone
No,
number.
dude's been really responsive to me.
I always am.
He's responsive to some people.
Yeah. All right.
Anyways, thanks for listening, guys. We will see you next time.